afternoon. Time to check in on the markets. Globally, as we look at the picture right now, markets easing even as Russia switched off a key gas tap to Europe for 3 days of maintenance amid fears that it would be switched back on, and also compounding the recession concerns. And this comes when we have central banks from both sides of the Atlantic preparing to raise rates at their next September meeting. When we look at the dollar performance being held up by the jobs data that came out yesterday. And we're talking here about the job opening and labor turnover survey, also known as the JOLTS, which is another key point that the Fed does watch. Locally, clothing retailer Woolworths reporting a flat performance, and this even as they cut prices to accommodate cash-strapped consumers. That share price nonetheless up 5.4%, and also mentioning that they are seeing increasing competition from their peers. And then you look at Cashbuild, which is another company that released their earnings, share price down 6%. They've slashed their dividends, and this again expecting tougher times ahead. But to give us a global perspective and also talk to some of the key data points that we are expecting, we're joined by Han Tan, who is from Exinity. Han, thank you so much for your time. How would you assess the global sentiment right now, especially when you look at the markets, and then you take in some of the comments coming out of the Fed chair and the Fed presidents?
Indeed. So overall, I would characterize it as there being a palpable sense of caution in the markets. You only need to consider how risk assets have fared in the aftermath of, like you mentioned earlier, Fed Chair Powell's speech at Jackson Hole to tell you that markets are very much gripped by the uncertainty surrounding what the Fed will do with US interest rates moving forwards. Now, although to be fair, there's been some doubt still about whether the Fed can follow through with its hawkish rhetoric, but I think overall that uncertainty is still playing out in the markets.
Right. Then you look at the euro-dollar performance, and the last time you and I spoke about the euro-dollar, we were having a conversation about it, getting to below parity, but it seems as though we're back here again with the same kind of theme, given some of the figures we've gotten out of the eurozone.
Indeed. So, I think overall, euro-dollar, although it has been straddling that parity line in recent sessions, I think the bias is still pointed to the downside. You just got to look at the downside risks to the eurozone economy, especially surrounding its energy crisis. So, even though there has been a lot of hawkish statements out of ECB officials in recent days, I don't think that's enough to really shore up at least support for the euro currency. So I think overall, we think there's still a greater than even chance that euro dollar could even hit 0.98 before September is over.
I mean, from your experience, did you ever imagine that we'll be talking about an ECB that is considering 75 basis points when it comes to interest rate hikes?
Yeah, well, it certainly was far from our minds as we entered this year. Granted, even at the start of this year, there were just murmurs about the Fed actually pressing ahead with its rate hikes, which, keep in mind, they had initially penciled for next year, only to move them all up starting in March of this year, right? So a lot has changed over the last 12 months, but the underlying fundamental case for that 75 basis point hike by the ECB is intact, right? And just hours ago, we saw a new record high for the headline inflation print. So all the more that justifies the need for the ECB to jump on that supersized hike bandwagon, so to speak.
And then you take things to, I suppose, the other side of the Atlantic, as I described earlier in my intro. Do you believe the Fed will continue increasing rates even in the face of a recession?
Yeah, the short answer is yes. I think that much is certain, and Fed Chair Powell also said as much that he's willing to risk that economic pain in order to keep not just the Fed's credibility intact, but also preserve its mandate of achieving that 2% inflation target, right? So now really it's a question of how much and how quickly, and the third component component will be how long they would keep those rate hikes or the rate at its peak until they can actually see consumer prices coming down. So as things stand, markets still think that 75 basis point hike for next month, that's I think our base case, and for many others, perhaps the peak could be at 3.9% by May of next year. And markets since Jackson Hole have certainly wound back some of the expectations for that dovish pivot for the Fed in the later half of 2023. So that's what we're working with right now.
Last year, when you look at some of the comments coming out from the Fed and even the way market participants were interpreting them, the idea was that we were talking about transitory when we look at inflation, and that got thrown out the window. And now the other theme is whether recession is going to be short and shallow. Are you buying that theme that the recession could be short and shallow?
I think a lot of that depends on the data, and judging by the positive surprises in the U.S. jobs market, even in retail sales, perhaps a lot less so in the housing market. But I think overall the prospect for recession is there and should be shallow. But then if you look at what the bond markets are trying to tell us, the bond markets are saying that it is something more of concern, perhaps more so than what stock markets are telling us.
Before I let you go, a key data point that you're focusing on for the remainder of the week?
Now, of course, the non-farm payrolls, which is due on the first Friday of every month, I think that's going to be key, not just for markets, but also, of course, for the Fed themselves, because if they still see that robust or resilient hiring in the US economy, that should essentially give them a green light to press ahead with those supersized rate hikes, right? And so two headline figures to keep in mind. One will be the 300,000 forecast for the headline non-farm payroll figure, and the 3.5% unemployment rate. So again, a better than expected jobs market in the US for August. We need another leg down for riskier assets such as stocks and
Han, let's leave it there. Thank you so much for your time. That is Han Tan, who is the Chief Market Analyst at Exinity, giving us a global perspective in terms of some of the key themes coming through and also throwing forward to some of the data points that are coming out on Friday, that key non-farm payrolls data.